Hi, welcome to our CIO series number 8. Uh, Today we're going to talk about China. Of course, everyone's interested, and also an update on global market views. Our PPT is having some problems, so I don't know, for some reason it's not moving. Okay, it's moving, but maybe not. It's okay now. Thank you. Okay, so one of the biggest challenges here today is really try to guess what the Fed rate is, and we are at odds of what the future holds for the U.S. interest rate. It seems like changing every day, and one of the most important events last month was not just the Fed meeting. In fact, on April 16th, Powell already gave us the clue that he is not going to cut the rate so soon. So that is one of the biggest drivers for the market down last month. We had a 6-day drawdown from April 11th to the April 19th, and that was one of the main reasons that the rate expectation continued to be pushed out. The good news is that last night the CPI number came in under control. It's more benign than people think. But if you look at the components, the biggest drivers are still oil price, fuel price, which feed into the transportation. And then you have the so-called shelter cost that's related to real estate. And then obviously the service segment of consumption continue to be strong, and inflation remains a problem. Now, despite all the uncertainty around inflation and continued delay in Fed rate cuts, we continue to like bonds. And I suggest we look at this way, that today you have a very attractive situation where the yield to maturity, the yield to maturity of the top rated corporate bond is still at over 5.5%. Okay, that is a good number. And then if you look at the inflation expectation, this is the break-even inflation implied by the TIPS security that's at only 2.4% long-term inflation. So and then you have a 3% spread, and that spread you don't get that every day, every month, or every year. And in fact, has widened year to date. That's why I think bond even more attractive than before. And a lot of our clients continue to buy bonds, even though they're realizing some losses market. So we continue to see strong demand for bonds, and we continue to like bonds. In terms of specific recommendations, we've been saying that people should lock in the yields with more intermediate maturity bonds. And here, be very careful to focus only on the top rated, the best of the best, the cream of the crop, single A rated above corporate debt to avoid the downgrade risk. It is investment grade, but it's top of the investment grade. What I'm trying to say is that not investment grade is safe because the US economy or global economy is uncertainty. In that case, if there's a recession, these lower quality, lower rating investment grade bonds will get downgraded, and that's when you will have trouble. So again, if you want to buy bonds, stay with a 5 to 8 year maturity, stay with the best of the best. And here's a table of the recommendations, and try to avoid high yield as much as possible. If you look at the spread of high yield, is not that attractive today, and a lot of research now suggests that high yield default rate in the US is going up. Okay, be very careful with that. We have a fixed income monthly. We already published that on Monday. If you'd like a copy, have more questions up bond, please contact Benjamin Tan in Singapore. Okay, that's on the fixed income and bond. For US market, we are cautiously optimistic. As you know, we cut the US stock holding from 25% to 20% in our asset allocation portfolio, the so-called all ETF portfolio. And that turned out to be an okay decision. The market was down 4% in April, S&P 500, but it rebounded quickly in May. So we'll see. At this point, like I said, we're cautious and optimistic. We're optimistic because we have seen continuing strong U.S. consumption. That's one of the reasons, despite the first quarter U.S. GDP came in weaker than expected, people tend to look past it and say, no worry, because the U.S. consumption is strong, right? And then AI remained the biggest driver for the U.S. market. And just give you some numbers. People complain, say, you know what, this market is all about AI. For the longest time, last year and year to date, and look at the recovery since April 19th, is also mainly driven by AI stocks. In fact, the Magnificent Seven accounted for almost half of the S&P 500's return year to date. And NVIDIA alone, that's 25% of the index return. That's pretty crazy. But if you look at the earnings number, it's not that crazy because Mag 7, they are making a lot of money in the first quarter. I'll talk about more detail later. 24% of S&P 500 earnings are from 7 stocks. That's extraordinary. So there's fundamental reasons why these stocks continue to do well. And without the 7 stocks, S&P 500 earnings will be down 2% versus up 5%. That's how extreme we are. And I remember the barbell approach I talk about how AI is going to change the world, and it's already changing the world. It's already have a huge impact on S&P 500 earnings. More on that later. We're cautious because of the same reason, right? So whatever goes up will make it go down. So we're optimistic about the U.S. because consumer spending is strong. But look at last night, the retail sales came in weaker and was flat. U.S. consumer sentiment was 6-month low because people worry about inflation, things getting too expensive, the wages not growing as fast enough, and then there are people who are worried about unemployment for the first time in the U.S. Okay, so these things all add up. Plus, this is the research done by a buy-side firm, but last year, I think it was the St. Louis Fed or one of the Federal Reserve banks already studied this, which says 3 rounds of stimulus checks resulted in the excess savings of how much? 2.1 trillion of U.S. households. That money's gone. It's being spent. Okay, and U.S. consumers are really good at spending money, as you know. So that's also the issue, the risk with the U.S. consumption. It's the driver for the U.S. economy, but there's also risk in the second quarter. And consumers, as you know, extremely unpredictable. So we're very vigilant about what the U.S. consumer is going to do in the second quarter. And there's a quick online survey saying that people are going to cut back. And the volatility in consumer spending make the GDP forecast also extremely volatile. Look at this. The GDP forecast will revise up 1%, almost 1% in 6 days. I've never seen this before. By who? Not by some intern. This is by the Atlanta Fed. The famous GDP Now forecast model changed the forecast by 1% in 6 days. And 1% is a really big deal. That's equivalent to the GDP of Finland in the context of the US GDP as a base. So beware of the economic risk of second quarter. I'm not fully convinced that GDP will be that strong going forward. And then back to AI, I've been saying that, this has to be a market driver. We like this for many reasons. I showed you this already, why AI is not a bubble. It's different from the internet bubble last time. I went through some of the company's cash level, market cap, and also the founder's age and experience and things like that. Let's talk about something more concrete, because now we have the first quarter earnings behind us. We can actually dig into the numbers and see what is the impact of AI on these companies. And this is, by the way, only 1.5 years, okay? November 2022 was the ChatGPT launch. And only 1.5 years into the launch, these companies already are making money. We published a report on this. I remember one of the weekly ideas sent out by Ryan in Singapore. We talked exactly this. We went through all the 6 or 7 company earnings, and then we also talked about the Wealth Monthly, if you like. So now we are seeing quantifiable impact from AI on big tech firms. And that's another reason to be optimistic. And in case you don't know, we also have a ranking of the Mag 7 stocks that we update every once in a while. Our new ranking, number 1 Microsoft, number 2 NVIDIA, number 3 Meta, number 4 Amazon, etc. And also the logic, the thesis behind all of this is really driven by AI. And we view Microsoft as the only company here that's going to benefit from AI in all of the short term, medium term, and long term. I'm not saying other companies not going to benefit. NVIDIA definitely a benefit, right? And the numbers are rock solid for the next 2 years, but year 3 is going to be a big question mark. So for NVIDIA, short term, no problem. Medium to long term is a problem. As you know, we talk about this a lot in Wealth Flash, in webinars, etc. And take Google, for example. Gary, what percentage of the sales from search? 90%? 90% of sales from search business. 10% of sales from so-called cloud computing, which is good, will benefit from AI. But in the 90%, the search business is under challenge by AI. That's what I mean. Not all companies are benefiting. They're benefiting some, and not all companies like Microsoft are benefiting in all fronts. And we talk more about this in the Wealth Monthly. Why we like Microsoft. Also, I can expand on this in Q&A if you like, why we think it's a beneficiary of all fronts, whether it's cloud computing or enterprise software. Okay, China, I'm sure everyone's interested because we have a sustained rally this time from the bottom in January or February, depending on Hong Kong or China. There are a few things that change in 2024. One thing I want to point out, I've said this before, that the market is pricing less real estate risk. Not only because fundamentally real estate is not as important to the Chinese economy, but also psychologically, the market has got over it. I'm not saying that real estate is not important, but just that incrementally is not going to be that important, right? So we had some good real estate news recently, but there are also some bad news in some days this year. And if you observe how the market trade, it doesn't care. We have the February real estate sales down 60% year over year, 60%. Look at the February market performance, it was up, right? So what does the market care? What does the market worry about? What is the risk? Is really about the broader deflation, which started when? Started mid last year when we had a rundown in inflation. We had people worry about weak demand, weak confidence, and so-called deflation. Deflation, by the way, is a really big problem for all economies around the world. So this is the risk right now for China. Something we need to watch. And the CPI number coming out this week also, I think it was tomorrow, will be key for the market. The good news that we are facing some low base from last year. So remember I said the world is getting more complicated, but the market is very simplistic. The market is not going to be so sophisticated thinking, oh, well, CPI recovered because of low base. If it recovered, it recovered, right? So CPI has a low base last year. Exports are low base last year this time, around June or starting May, June, and all the way to July and then August. And real estate sales also have extremely low base from last year. So that sets up for a so-called a seemingly strong recovery in the next few months. This is something we should pay attention to, right? On the macro front, the numbers going to come out, seem pretty strong, and it will improve the market sentiment. And most importantly, it's going to make it like the policy is going to work. It's working. In reality, I don't think the policy is working, but it will make it look like it's working, and that's an additional driver. And that's why we're also optimistic about China in the short term. But I also said, something about our investment strategy in China. As much as we care about macro, as much as we care about market direction, ideally we shouldn't worry too much about macro, because you want to invest in areas that has more structural growth, that has more growth regardless of whether the economy is growing 4% or 5% or 6%. Of course, if the economy collapses, nothing works. But you don't want to invest in the area that's so sensitive to the economy. And what do we have here? Not a whole lot. If you look at, like I said, even though Chinese economy is not that bad, but it's not that good either. Right? So what are the bright spots in Chinese economy today? I think domestic tourism is one of them. If you've been following Chinese news, if you've been to China, a lot of Hong Kong people go to China now every weekend, I know, to Shenzhen to shop, to relax, to spend time and spend money. If you go to China, you'll see this is happening. Overcrowdedness, during the peak seasons and that type of things. The numbers also show that you have triple-digit growth in tourism last year of the pent-up demand, right? Because the things are reopening. But I think there's a more important structural change. Again, back to what I was saying. You want to invest in places or trends that are more structural. It's not just a 1 or 2 year, not just because of cycles, right? Or you can say it is cycle, but it's a bigger cycle. Okay. The domestic tourism in China, I think it's a 10-year cycle. And we're just in the beginning of it. Interestingly, this has everything to do with real estate. Think about what I was saying. And we actually wrote about this in the Wealth Flash, and because of the time limit, I'll talk briefly. You can read the report. The title is really about domestic tourism beyond this pent-up demand. Why real estate has anything to do with this? Because the weak real estate market forces the central government and the local government to find new ways to grow the economy. Especially for the local government, think about them. They're losing the land sales as the financing channel, right? 我们叫这个土地财政, right? It's gone. So they need new sources of revenue, and tourism seems the natural choice. It's a low-hanging fruit. So you see all of the governments, local and central, are talking about it. In the appendix of the report, we have a long list of the policy. The day we published the report, China just opened up another 15 cities to Macau and Hong Kong. And then yesterday, China opened a new visa policy or visa-free policy for cruise ships coming into China. So just give you two examples of how quickly things are happening here in terms of policy. And then in terms of demand, think about what happens when people are not buying much real estate. Personal savings now a record high. Last year at about 17, 16 trillion. The year before at another close to 19-something trillion RMB of personal savings. People are worried about the future. People are losing jobs, but the savings are piling up because they're not buying much real estate. That means they have more money to spend on other things, right? So, and that one thing is tourism. And then there's also the rise of the so-called thematic and cultural tourism. And this is a structural change, another structural change. Think about China moving to a more advanced society, the rise of individualism and that type of things. And then this is still very early in the stage for China tourism. For Hong Kong people, for Singapore people, you have no feel because you're used to vacationing, leisure travel. But just the concept of taking a vacation for most Chinese, it's a very foreign and new concept. You think about like people from the countryside, there's no such thing as vacation, right? Vacation. They travel for Qingming Festival. They see relatives, right? They go visit families. But the vacation is a brand new thing for a lot of the Chinese people. And then even things like air travel. More than 1 billion Chinese people will never travel by flight until today. That's 70% of the population. And then the average flight is 0 point something versus in the US, the average person takes 4 to 5 flights. There are a lot of numbers here that to show you that really we're really early in the stage. And then, like I said, we have these drivers that are driving the domestic tourism to think about it, there aren't that many trends in China that's supported by both. Okay, take internet for example, take online gaming for example. Of course, there might be drivers, but online gaming is a very mature market. Okay, but domestic tourism is not. And then here, some data in Chinese also suggests that the biggest growth first quarter came from the countryside. That's very interesting. The farmers, the peasants, the people who never expect to travel, they're now traveling more. Why? Because maybe for the first time, somehow they end up on a tourist trip, on a package tour, tourist package somewhere, and they liked it. Now, people who never traveled for leisure before is developing a habit. This is from 0 to 1. Right? This is very powerful change in China. Our topics for this change of sector remain Macau gaming. Macau gaming is probably the only pure play here in terms of industry. Of course, in China, Asia, there's a lot of tourism companies that go public, but the quality of those companies is very poor, and the corporate governance is a big issue, and they have lots of connection with the local government. You don't want to get involved in those situations, right? So a lot of local tourism companies that are not investable. Macau gaming, totally investable, all right? It's the biggest in China, the biggest in the world, and it's 96% of tourists come from China. And then we like two companies, we said before, Sands China and the Galaxy. We buy them for the scale. This business is about scale. Because whether for non-gaming or gaming, you need a scale advantage, right? The scale will give you the brand, will give you a lot of other things. And I can talk more details later. But the non-gaming growth also interesting. Please don't think about Macau just as gaming. The non-gaming growth tend to be faster than gaming, and the best play is Sands China. They have 26% revenue contribution for non-gaming. The margin here could be as high as 90% in terms of retail, and they have the biggest retail space in Macau, 2 million square feet, the size of a harbor city. They own the whole thing. And not harbor city, but the size of a harbor city in Macau. If you count all the shopping space under all of the casinos, like the Parisian, the Venetian, etc. Okay. And then one thing added to that list is the C-Trip. This is the largest online travel agency in China with a 55% market share. They're expected to grow about 15-20% in the next 3 to 5 years. And today they have about 75% revenue contribution from domestic tourism. Again, perfect to match with our domestic tourism trend, but also watch for their international travel this year and next year. Because in normal times, that domestic tourism should account for only about 65 to 70%. Right. The reason we have such a strong contribution because the inbound or cross-border travel has been weak, but that's also recovering fast this year. So C-Trip, that's almost a perfect play on both the domestic tourism and international tourism in China. And before I finish to talk about to give you the Q&A, let me remind you our barbell approach to stock picking. Some of you have seen this, you may not have seen it, but it's really playing defense and playing offense. Imagine you're the coach of a basketball team. You want to have both good defense and offense, and you want to have food and stable energy as the more defensive plays, and then high-tech innovation like AI, which is very volatile. Okay, the video is very volatile, but now it's back to 900 something share price. But high risk, high reward. You match it up with something that's low risk, low reward, and you have a good portfolio, as opposed to investing something in the middle. Now, what is something in the middle? I've been giving a lot of examples, but let me just give you one example. Insurance. That's some stuff in the middle. Recently, look it up. Online, people are talking about Tesla's robotaxi, Tesla's driverless technology. And a lot of people are still skeptical. They say this is no good and this is, but regardless of how much people, how much adoption there is for robo-taxi and smart driving and driverless technology, the facts are robo-taxi is going to reduce the percentage of accidents by at least 50%. And these are hard numbers, okay? So think about what that means for insurance companies, for people who sell car insurance. When the premium may have to drop because your accident rates are going to go, the business might be gone. There may not even be a need for car insurance because the accident rates will be so low when you adopt something on the right, which is AI, robo-taxi, and these high risk, high return situations are going to change the world we are living in. Okay, I'm going to stop here and take any questions. If you have a question, please use the chat window again to type your question. This one, test for Q&A, right? Oh, no, it is happening. Okay, let me see. I always have trouble with this. Can you drag this out? Oh, this here. And then blow it up, okay. First question, what is the forecast for the Hang Seng Index for 2024? X 2000, 24,000, etc. Your opinion. I can give you my opinion, but I don't really have an opinion. I suggest, I don't think by year end, I would say Hang Seng can reach 20,000 in the next 3 to 6 months because of the low base effect I talk about. We're almost there already, right? It's not much of a upside from here. The reason we don't give the year-end forecast is actually kind of useless. Even if I can tell you accurately what the Hang Seng is going to be at the December 31st, 2024, what are you going to do about it? You buy now, you sell on December 31st, you still have to stay invested on January 1st, 2025. Investment is a rolling game. It's a continuous game. So I will not get into that forecast. It doesn't help anybody. It just feels good, feel like I'm really smart. I can give you that kind of forecast. But if you really think about in application, and you can buy options, you can buy call option, but the time decay is going to kill you. Right? You can, if I say it's going to reach 20,000 on December 31st, of course you can buy call option at 2,000, but I don't think that's a good trade. So please, long-term investment, avoid timing decisions. Think about this as a rolling process, continuing, ongoing process. Otherwise, probably we don't even have a business here. Our business is based on that investment is a continuous game. Is Apple still a long hold option? Let's see. This is cut off. Apple long haul, and we actually, for Apple, we actually don't like it. Apple ranked number 7 in Magnificent 7. No, I don't think Apple is a buy and hold. If you have Apple, and if I have Apple, I would sell. I would take profits now. Warren Buffett is selling for sure, and then he'll continue to sell. And he's being polite, saying that Apple will continue to be his number 1 position. For Warren Buffett, if he sells, he sells. Okay, he barely changes direction. All right. The reason we don't like Apple is that it really lacks a clear and convincing AI strategy. And they have the last opportunity now in June, the Apple Develop Forum, to launch something that to the world that hopefully could change the whole fate of Apple in the next 10 years. But if not, it's going to be years behind the other guys. Apple recently, there's speculation they're going to work with OpenAI on ChatGPT type of technology, which I think is true. They can't come up with their own technology now. And Sharia as being a complete failure in terms of AI technology is a joke. So any tech company that does not have this exposure or do not have this strategy in place, it's a sell. Apple, it's a buy. Apple does have potential to be downgraded to something like a Xiaomi, right? It's a consumer company. It's not a tech company, but it does not deserve that current valuation, certainly. Okay. Impact from U.S. tariff, major impact affecting the Hong Kong mainland economy, if any, explain in details. I have not studied this topic. This just happened overnight on or last couple of days on additional U.S. tariffs. I will not take this seriously. On the negative side, I don't think Chinese exporters have the pricing power. So look at what China's State Department said. Said the U.S. is shooting themselves in the foot because raising the tariffs will allow China to raise prices, which will increase the U.S. inflation. That's wrong. That's completely wrong. Okay, so China's going to the low-end exporters, people who export shoes and textiles and subject to those tariffs, which I don't think it's that much of a big deal, right? Total importing about 16 billion of total exports of goods of the current rounds of tariffs, they're going to suffer. And like I said, these are stuff in the middle. We're not going to invest in anyway. Like I said, you invest in really stable food and energy or technology, right? These are not technology plays. So China will definitely have some impact in terms of limited impact on the U.S. tariff fund exports. One thing to note that the export structure, I think there used to be a chart here in my PPT, of China is changing. The growth is no longer those areas that's facing tariffs. Well, there is the auto, but whatever the auto tariffs, China is not yet to sell the complete EVs in the U.S. Very, very small amount. Okay, very small. So that's very little impact. However, China does sell a lot of auto components and also other industrial goods that are not subject to tariffs to the U.S. and also to the rest of the world. That's why we're bullish on Chinese exports for this year. Airports in China, we used to like airports. The airports, the story is really about duty free. Other than duty free, airports is like utilities, right? It is stable, but also from time to time it has some regulatory risk, not too much. For the tariffs they charge and stuff like that. So for airports, the issue right now is that the international travel has slowed down significantly. There are two issues. The international travel, the flights are not recovered back to normal levels. So, for example, the U.S.-China flights on paper is recovered to 30%, but that's counting Taiwan and Hong Kong, right? So if excluding those places, it's recovered maybe only to 20%, 10 to 20% of the pre-COVID level. So less people going abroad for various reasons. And also there's a kind of a consumption downgrade in China now. So that's another thing. Tourism is good because tourism, you can spend $10, $20, $200. You can spend, right, any amounts of money. But for international travel, it's a big ticket item purchase. And also for duty free, usually cosmetics, electronics, those things cost money. So people are spending, definitely, we are seeing strong evidence that people are spending less money on duty free goods because of these reasons. So airports, no. Would they benefit from tourism boom? Yeah, well, I just said earlier, for domestic tourism boom, their upside is limited because, you know, airport, the fees they charge are regulated. And also, you know, some airports still have to spend a lot of capex to the maintenance capex, and so cash flow wise, it is not as good as say Macau Gaming or Ctrip, those companies. So they do benefit, but not as much. And the airline too. In theory, they should benefit, but airlines are another set of issues like competition, like the rising oil price, like the US dollar debt versus the RMB income, which is a problem when RMB depreciate, and also the lack of, like I said, the challenges with the international flight resumption. Should we wait in June to sell Apple? Are their competitors like Samsung, Xiaomi do not have much plan in AI? Yeah, they don't have plan in AI, but they don't claim to be Apple, right? And they're not trillion-dollar companies. Apple is a $3 trillion company with no AI strategy. Is it the world's second largest company, right? The world's second largest tech company, and has failed on EV, failed on AI. What else they failed? They failed on so many things that, in the last 1 or 2 years, it's disappointing. Failed on iPhone in China. The iPhone is completely not innovative. Look at the shape and how it's changed. The iPhone is all about a better camera. Who want a better camera? That's not innovation, right? So for Apple, they do need AI. They're an important part of the tech the ecosystem. Unfortunately, they don't. So that's a problem more for Apple than the ecosystem, because the rest of the industry which is just catch up. So Apple, yes, they do have, well, compared to Xiaomi, definitely they do have better technology. And they have lots of cash. So these are the reasons that Warren Buffett probably still like them. They're stable. They're no growth, but they're still stable. But would you buy the company for stability? You could, right? So then naturally we need to look at the valuation. Check out what's the Apple valuation right now. I don't think it's as attractive as some of the other stable plays. Okay, so of course stability doesn't deserve a premium. Okay, Chinese government issue super long-term bonds. What are they going to use it for, and what is your opinion? Yes, that's also a very good question. This is the first time they do this. The last time they do the special bond was 2020, but not as this long term. The specialty of these bonds, number one, is ultra long term, 30, 40, 50, 20, 30, 50 years. Number two is they're not counted as China's budget. Remember, budget is a big deal for China. China almost never try to breach, let's say, 3 to 6% budget. So in this case, for the bond issuers, they said 1 trillion. Theoretically, they can go to 5 trillion because it's not going to affect the budget. Of course, the purpose is really to stimulate the economy. And according to the decision from the March Congress, what they said is to use for strategic reasons and national security reasons. And that's a very broad area, by the way, right? So they want to do both. In fact, probably the strategic angle comes first. Remember China's security agenda. What kind of security? National security, food security, energy security, cyber security, transportation security, right? You go back to the Chinese documentation, it's all about security. So I expect a lot of the money will be spent on the area. And you really think about all these security, whether it's food security or national security, is about energy security. If you have energy security, you can solve 90% of the security problem in the world. That's what I expect. A significant amount of spending. Again, I cannot speak for the Chinese government, and it's probably national secret now. How are they going to spend the money? A lot of that money will be spent on energy infrastructure, that including natural gas, right? Refinery, transportation, exploration, crude oil, overseas acquisitions. So what does that mean? We continue to like PetroChina and CNOOC. And these are the two biggest beneficiaries of China's security, energy security agenda, and also this $1 trillion ultra long-term bond issuance. I think a lot of it coming as subsidies, explicit or implicit subsidies to all your Chinese energy companies around the world to do businesses around the world. Okay, that's point one. What also is kind of a national secret is who's really buying this bond, right? That's a key question, because that leads to whether they're monetizing the debt. Okay, that is the key question. So It's not just about the ultra long term, it's who's the buyers. We don't know yet. If turn out that 20-30% is actually bought by the central bank, or central bank in turn have a special facility available to buy these type of bonds through commercial banks, let's say, that is essentially monetizing the debt. And that also has never happened in China before. So that has major implications to financial markets now. It's not just the real estate market. It's not just the economy. Okay, so this also will be a big deal to know. We don't know like who the ultimate buyer is of these bonds yet. Okay, geopolitical risk: Ukraine war, Israel, Taiwan, China. Are these impacting Hong Kong, mainland China's economy? It does impact the sentiment, I would say. So far, in terms of well, the only area I see some positive impact is energy, right? So you're seeing, again, back to these oil companies that they're doing a lot more business with Russia now. They're doing a lot more business in Africa because the vacuum that's left by the U.S. or whatever, the U.S. is too busy solving other problems around the world. So China is taking advantage of this by, trying to solve its own energy security problem. So that's probably one answer in terms of geopolitical risk. I don't track these type of things. Like I said, as a firm, I don't think we can make money from geopolitical risk. As a research team, also, I don't think we have any specialty in terms of geopolitical risk. But it does impact the sentiment in China. And I would say, the last 3 years, China's valuation multiple has contracted to such a large degree, has to do with Taiwan, China, and all these geopolitical issues. But I just don't know how to quantify that. And I just don't know how to integrate this into a sector strategy or stock selection. Like I said, if you want to pick a stock, try to pick a stock not affected by any of these, okay? Otherwise, it's going to drive yourself crazy. You're going to drive your clients crazy. You're going to lose sleep. And you can't do anyway. Even if I tell you, 1 week from now, there's another war breakout, what are you going to do? There's no trade, you see? What are you going to do? You don't know how the market's going to respond, right? So do you think necessarily the war breaks out, the market will go down? No. Historically, it's not consistent. The evidence is not consistent. So let's try not to make such a big deal out of these things, even though it is important for the world politics. But for our strategy, is not that important. In fact, if it does affect our strategy, that means our strategy is wrong. It's not the right strategy. Regional countries, quoting mainland China to come to the countries. Yes, we're seeing some visible impact from visa-free travel between China and Malaysia, Thailand, and Singapore. A sudden jump in. We don't have the latest stats for May, but we do have the stats for Chinese New Year. We have a large jump in tourism going to those places because of visa-free travel. Will the majority of the Chinese residents prefer to travel domestically, or will it be the impact to the economy? Yes, the majority will continue to travel. If you look at where the growth come from, okay. So let's look at going back to the domestic tourism story. The volume is going up. The volume this year is going to go up another 24% year over year, but the spending is going up only 22% year over year. So what's going on here? The interest is there. Everybody want to travel. Everybody want to travel more, but people are spending less money. So of course, domestic, you spend less money. There are actually, these college students, they do some they do like sort of special forces travel, right? Which just costs nothing. They spend minimum amount of money, travel 3 cities in 3 days. Yeah, the volume is up, but this is not a consumption upgrade story. This is a consumption downgrade, but the total volume is up and the total spending is still up. But this is not, like in the old days when you have both the spending per person go up and also the volume go up. So this is different this time, and that's why the international travel will be limited, also because of RMB depreciation, also because of lack of flights, right? I think Thailand and China just open more flights. They need to double the flights. The flight is a problem, international travel. Domestic, not a problem. What's the likelihood of the pattern of travel? So this year, I'm not sure what you're asking there, but I think this year domestic will continue to be strong. Like I said, 20+% growth, but international will be stronger off a lower base, only off a lower base. Going forward, the more sustainable growth, if I were to bet on one trend, that is still domestic travel. It's a bigger volume, bigger spending, more sustainable. It's more flexible, like I said, right? Today, whether U.S. consumer too, Chinese consumer wants something as flexible spending budget. If you want to go to Singapore, there's a minimum amount of money you have to spend. They don't like that. They want to say, okay, I have $500 now. Where can I go? Right? I may not want to go to Singapore, Malaysia, but maybe I can go to the next city for overnight. Opinion on rate cut in the U.S., when would it occur? Also, very good question, really hard to answer. We have no value, no extra insight here. But let me tell you this, the good news, remember going back to what I said, inflation, finally, the April CPI in the U.S. begins to show some signs of taming, and our PPI will come out today, I think, and also consumer spending is cooling off. Also, consumer spending, consumption is 67% of U.S. GDP. So I'm sure the Fed will look at this number and take that into consideration, right? The consumption, retail sales just come out, 0% growth, right? And then we have consumer sentiment, also the CPI, PPI, yeah. These things will hopefully move the Fed into a rate cut, but not in the short term. I don't think the Fed's view of not cutting in June and July is going to change. And then now we come in with August. So maybe August may be the last chance. We're heading to September. I said on the last call, it's going to be very tricky because we're heading to the U.S. election season, and the Fed is not going to do anything until November, right? So either August or November. And I think there's a decent chance based on the data. Oh, by the way, the labor data too. The labor market is also cooling off. That's good for lower inflation, higher unemployment, slowing economic growth, slowing consumption, slowing services consumption, et cetera. All these things will add up to hopefully to convince the Fed to cut at least once in August. Okay, so will the plan by Thailand to build a number of casinos adversely affect the Macau gaming? I don't know anything about the plan about Thailand building. Like I said, where do you think that the tourists will come from? China again, right? So is it easier for Chinese to travel to Macau or to Thailand? So that will answer it. I think Macau still has that appeal. It's proximity, no language barrier, and it's the biggest gambling center in the world. And Sands and Galaxy have not created this icon or status symbol of Macau as a must visit. Macau is also part of the cultural tourism theme, right? As a UNESCO World Heritage Site, that type of thing. So again, if you've never been to gambling, never been to any places, I think Macau is still the first place to go. That's my personal opinion based on my study of the Chinese consumer behavior. Thoughts on the US dollar versus RMB and gold this year? Yes, that's also a very good question. I think RMB, let's start with RMB. RMB, I think, is facing some pressure. And this pressure will persist, even though now we have some rebound, but it's not going to go away. And we may even possibly look at a one-time devaluation. And by that, it's going to be different from other type of one-time devaluation, okay? So, because China has a controlled band. So what that means is the band will move wider or maybe the middle of the band will move lower. It's not like Argentina, you suddenly, overnight, you get go down 20%. That's a currency collapse, okay? I'm not talking about that. But I'm talking about a one-time adjustment of the band and the midpoint. And that could be significant still, as much as, let's say, 5% one time. Two reasons. Number one, China needed to reduce more economic pressure by depreciating currency. Number two is that by behavior, if you look at what China is doing in the last 6 months or 12 months, they've been buying a record amount of gold, coals, energy, oil, natural gas, soybeans, commodities, you name it, right? Record amounts. And that's usually viewed as a move before a one-time depreciation, so-called. And they did it last time they did devalue the currency, they did the same thing. So that's why I think there's highly likelihood you can see a one-time devaluation of RMB. And on gold, I would say gold will continue to go up. If the Fed cut rates will go up, the gold will probably go up even further. We made the right trade on gold this year. We started with a 4%, then we added the 5%. Gold is now the best performing asset class year to date, even outperforming the S&P 500, believe it or not, right? So why is that? Well, the Fed rate cut, people expected that before. There's also geopolitical risk. And third, this is new, that people are frustrated with the central banks. I'm not sure we talked about this before. It's out of frustration with, look at Europe, look at Japan, look at US, look at the Fed, right? So indecisive, unable to control the inflation, indecisive on a lot of the monetary policies. There's a lot of contradictions on what they say and what they do. So because gold is not controlled by the central bank and people buy it for that reason. And also there are a lot of countries like China, I said, importing gold to prepare for maybe some kind of devaluation or depreciation. So gold price, I'm bullish. It's an area that I cannot trade. I cannot advise you how to trade day to day, but it's something you buy with your eyes closed and keep it. Okay, Dell's doing well with the selling AI server and PCs. Will Lenovo be a good bet? Servers, no. I think servers in generally are fake AI plays. They're not real AI plays, including the company SMCI. Used to be growing, used to be making 5% net margin, now maybe 7 to 8% because of AI is helping, etc. But don't forget, this is still single digit, low margin, low value add, and without AI it would be low growth or even negative growth, right? It's definitely the opposite of being resilient. This is a very fragile AI play. That's why I don't think it's a real AI play. If somehow there's any hiccup in AI demand, these guys are the first to go. So no, I don't like any of these things. Plus, Lenovo has major corporate governance issues. I know analysts may be recommending it, but they don't look at corporate governance. I do. For Lenovo, major corporate governance issues. We can talk in detail later. Okay, CGN mining and CGN power further benefit long term. Are you talking about nuclear power? Yes, but it's not a high growth opportunity. I think this is a steady growth with certainty and with scarcity value because they're kind of monopoly in China, the CGN power in charge of developing nuclear power, if I'm not mistaken, in China. Okay, so for China to go to net zero or the carbon neutral, they have to. The only way is nuclear. I've been saying this before. I don't know these two companies particularly well, but I know the industry is heading to a more high certainty growth situation, and then also pay dividends. Trip.com still a good stock to investing. Where would the further upside come from? Yes, Trip.com. If you want to own one online travel, that is the one to own. At this point, I will even recommend them over the U.S. counterparts because valuation is more reasonable. And this used to be the biggest in the world, by the way, only because of COVID now it's down to number 2 and 3, but they're going back to number 1 again. Like Macau gaming used to be 6 times of Las Vegas, and then lagged and now back to number 1 again. So Ctrip will reclaim the world's number 1 online travel by GMV, purely because of domestic travel. So the upside will come from, I said before, this year, next year, the main driver will still be, in terms of volume, in terms of revenue contribution, majority will still be the domestic tourism. And then I went through some of the secular drivers, right? Cultural tourism, thematic tourism, policy support, and then the increasing personal savings will get people more money to spend, maybe not spending on everything, but tourism is something they can afford. And then very important, once it becomes a habit, think about drinking coffee. Chinese people never drink coffee, or rarely drank coffee before. But now if you look at the cities, a lot of young people, a lot of mid-aged people, the population is making drinking coffee a habit. What about making domestic travel a habit? Become a recurring thing. That's what the upside will come from. You have a huge step up in demand. We're not just talking about 15, 20%. In some cases, you could have a huge setup. We don't know, in fact. Right now, we're expecting Ctrip 15 to 20% growth. But there could be a huge step up sometime in the future, near future, because of people making travel a habit. And China is still early in terms of travel adoption, as I demonstrated to you earlier. Will China continue to reduce the holding of US Treasury bills? Will China continue to increase the holding of gold? Okay, there's misconception. China is selling US Treasury. That is wrong. China's holding, China's not net selling. China's holding of US Treasury go down is because as the existing ones mature, they're not buying as much new ones, number one. Number two, a bigger factor is not because China is not buying less, is because US is issuing a record amount of treasury bills. I don't have the number top of my head, but year to date it's in the trillions of dollars. Another trillion, several trillion dollars new bills being issued, new notes, right? So, and China not catching up fast enough. Both China and Japan are not catching up fast enough on the purchase. That's why the percentage of China's holdings come down. It may be intentional. In China's case, you need to defend the currency, so they need to sell US Treasury or to buy less US Treasury. That's certainly true. And also, US want to decouple for China. China also want to decouple from the US. So that's another reason they substitute that with gold. And gold, like I said, is decentralized and it is not dependent on any central bank around the world. So the trade is still gold. I can help answer all these big questions, but I still want to tie this to its investment conclusion that, now we see record demand for gold by countries around the world, not just institutional or individual investors. S&P versus NASDAQ versus China A50 versus HK50. Which would you rank first, second, and third? Index level, I would rank HK50 first, followed by China A50, and then S&P 500. Now, S&P 500 NASDAQ is hard to say. It's hard to say. Maybe both number 3. And there are reasons to own both. Or NASDAQ, of course, there's more tech exposure, but there's also a lot of pharmaceutical exposure, which has some headwinds recently. So again, HK50 followed by A50, and then the two of the U.S. indices. SMI has become a long-term play with U.S. sanction. Yes, we do have SMIC in our core recommendations right now. Has been there for a while. It's the worst performing stock in our portfolio. And I do have to apologize for that, down 20% since we bought it. They have some cyclical issues because of recovering slower than expected consumer electronics demand, handset demand, that type of things. And then they're spending, on the other hand, they're spending more money on CapEx trying to catch up with TSMC. So on one hand, you can see the business not growing as fast as expected. On the other hand, they have to spend more money. Of course, the overall profit or earnings will suffer in the short term. Long term, I would say we don't have a choice. What else do we have, right? So SMIC is the only leading edge foundry in China, and is the closest proximity with Huawei. If Huawei is a listed company, we would also consider, but Huawei is not listed. So this is the closest thing we can get to Huawei. And Huawei, like I said, both Huawei and SMIC are probably the only hopes that China have in terms of closing the gap. Forget about catching up. No way we can catch up. But at least closing some gap with the US on AI, on advanced semiconductors, on these 4 nanometers or even 3 nanometers technology as we migrate towards more leading edge nodes. So no other choice. So it's kind of, we're stuck with it. Either we get rid of it or we just don't believe in this trend at all. I personally still want to, it's not a big position in our portfolio, model portfolio for SMIC, so I still want to keep it as kind of a bet that China will eventually catch up. Okay, I think that's all the question we have. Oh, there's one more. Thoughts on the impact of rapid Chinese population aging and low birth rates on the Chinese economy? Yes, we are looking into this right now. That's another reason we removed Tencent from our core recommendation. Okay, again, every question asked, I want to tie to investment implications as possible. Online gaming, the reason it's a maturing industry because of this. The population is negative growth probably, right? There's no new users of online gaming in China anymore. In fact, the industry will be growing at best 3% a year, and that's evident in the Tencent numbers too. Latest numbers, quarterly numbers. And if you look at all these gaming companies, what they focus on outside of China, right? International gaming growth, but that is also challenging. And I bet this will also run into a TikTok situation, run into some kind of anti-China sentiment when you have Chinese gaming companies offering services in Western countries. Okay, so it's also a dead end. So that's one implication. That has implication to consumption. That's why going back to domestic tourism, if you look at each segment of consumption, print out the numbers, look at the total social consumption, they call the 社会商品什么零售啊, right? If you look at those numbers, most of the numbers are no growth, or very little growth, and slow down significantly. Why is that? Because of low birth rates, because of aging, because of many of the demographics related factors. So huge implication to consumption. You don't invest in China anymore for the general consumption. Don't ever buy a stock in China that's capitalizing on the general consumption. Worse yet, don't buy a stock banking on consumption upgrade. No, there will not be consumption upgrade. We like tourism again because it's not a consumption upgrade story, right? I already demonstrated to you. It's a downgrade story. You can spend any amounts of money in tourism, okay? But more people spend, that's a good sign. But average spending, we're not banking on it. Okay, so that's the last question. I want to thank everyone for participating. And the recording of this will be made available to all of you, and I'll also circulate the PPT for today for your consideration. There's a disclaimer at the end of the presentation. Please read it. Thank you all, and I hope to speak to you next time. Bye-bye. So, 1 hour, right? It should be